All right, so today we're gonna get into a big money discussion.
Oh no!
That probably will feel a little bit like alphabet soup, but we're gonna talk about retirement accounts. Specifically, 401ks and IRAs and their two respective sub-account types, traditional and Roth. So today we're gonna answer 4 key questions about common retirement accounts. Number 1, what's a 401k versus IRA? Number 2, what's a traditional versus Roth account type? Number 3, what are the advantages and disadvantages of each account and account type? And probably most importantly, which ones should you use and in what order should you use them? So by the end of this video, you'll be able to make a much better informed decision and be able to do your own research based on your unique situation. Let's get into it. Now, for everything we talk about today, we're going to deal with 2 key terms: contributions, or what you put in from your money, and gains, what your contributions earn in investment growth over the years. So let's start with the basics and answer our first question: what is a 401k versus IRA? Today we're going to reference this handy chart throughout to help keep things clear. Here are the 5 key high-level differences between a 401k and an IRA. First is how you can get an account. A 401k is a retirement savings plan, usually offered by your employer, or if you're self-employed, you can open one yourself. You put money into it straight from your paycheck. You can also usually move this 401k account from employer to employer when you change jobs, or even roll it over into something like an IRA. Speaking of which, an IRA, short for individual retirement account, is something you open on your own. It works in a similar way, but it is unrelated to your job. Now, in some situations, depending on where you work, like maybe nonprofits or the government, you may not have access to a 401k through your employer, but instead you have access to a 403b or a 457b. These generally have the same contribution limits, which we'll talk about soon, but they also may have some additional perks or restrictions. Today, we're just going to focus on 401ks and IRAs. The second key difference is how your contributions are invested. For a 401k, since it's employer sponsored, you'll have a pre-selected list of mutual funds to pick from. You typically can't choose your own funds or any individual stocks, just what options they have already assembled for you to choose from. IRAs are different though, since they are entirely self-managed. Here, you contribute your money into the account, but that just puts it into a cash account. You then must choose where to invest it. Maybe also mutual funds, or maybe some ETFs, or maybe individual stocks, or maybe some of all of that. It's your choice. But, and this is critical, you must choose something, because if you just let it stay in the cash account, it's not invested and it won't grow at all. The third difference is whether or not you can get an employer match. 401ks often come with some sort of employer match that doesn't count towards your maximum annual contribution. However, since IRAs are self-managed, there's no match available from your employer. Fourth is the maximum amount you're allowed to contribute to each account annually. For 2025, a 401k has a max personal contribution limit of $23,500 for those under 50, $31,000 for those 50 and up, and there is a small 4-year window for those 60 to 63 where the amount increases to $34,750 and then falls back down to $31,000 after that. However, for an IRA, these amounts are much lower. $7,000 for those under 50 and $8,000 for those over. Now, these amounts are typically adjusted by the government each year since they all carry important tax benefits. And fifth, the last key difference between 401ks and IRAs is that IRAs have income limits for certain benefits that start phasing out at specific income levels. In 2025, a traditional IRA starts phasing out the tax deduction for single filers at $79,000 modified adjusted gross income, or MAGI, and for married filing jointly at $126,000 MAGI. This doesn't affect non-deductible contributions, which remain unlimited. And Roth IRAs for 2025, the phasing out starts at $150,000 MAGI for single filers and $236,000 for married filing jointly. The key distinction here, though, with the Roth IRA and the phasing out is that your ability to contribute at all is what phases out. Now, within 401ks and IRAs, there are two account types, traditional and Roth. So let's answer question number 2. What are traditional versus Roth account types? Traditional and Roth accounts differ in 4 main areas. First is when you must start withdrawing your money. This is federally mandated, and these are called required minimum distributions, or RMDs. For traditional accounts, RMDs begin at 73. For Roth accounts, there are no RMDs. Second is what kind of money you contribute. For a traditional 401k or IRA, you contribute pre-tax money, meaning you lower your taxable income today. There is some nuance here to your traditional IRA contribution. It will most likely be actually a post-tax contribution that you will then deduct from your taxes to get the taxes that you paid on it back, which sort of effectively converts it into pre-tax money. And then you will pay taxes on your contributions when you withdraw, just like you would for a traditional 401k. For a Roth account, both 401k or IRA, you contribute after tax money. So there is no tax break today because you have already paid your taxes on it. The third difference between the traditional and Roth account is when you pay taxes on contributions. For traditional accounts, you'll pay taxes later when you withdraw in retirement. And for Roth accounts, you pay taxes on the contributions before you even contribute them. And then when you withdraw in retirement, you pay no taxes on the gains or growth that your contributions experienced. For traditional accounts, you pay taxes on your gains when you withdraw them in retirement. For Roth accounts, you pay 0 taxes on your gains. Now, if something in your brain just went, wait, what? No taxes on gains? You would be correct to think that this is crazy, because it is, but it's true. Roth accounts have no taxes on gains. That's 100% free growth. So let me give you the best example I can think of to show you the real value of Roth versus traditional accounts.
I love the chase and the hunt, and I set the pace when I'm running. I always take what I want and I always give it 100. Don't need a
If you're 30 years old and you maximize your Roth contributions for 35 years, you will have contributed $260,000 based on 2025 contribution levels. But your account balance, based on a conservative average annual return of 7%, and really the average is more like 10%, will be just over $1 million at age 65. In a Roth account, you only paid taxes on that $260,000 in contributions, and you already paid them before you even made the contribution. The other approximately $750,000 in growth is yours tax-free. If, however, you put the same amount of money into a traditional account, IRA or 401k, you will still have contributed $260,000, and you will still have just over $1 million at age 65. But now, when you take your money out, you will pay taxes on not just the $260,000, because you haven't paid any taxes on it yet, but all the gains too. You'll be paying taxes on over $1 million in income versus $260,000 with a Roth account.
I'm so gone. No, I'm
Roths are incredible tax-saving vehicles. There are two other differences between the account types. First is early withdrawal limitations. Here, it's the other three account types that have the worst benefit. Traditional IRA, traditional 401k, and Roth 401k do not allow withdrawals earlier than age 59 and a half without incurring a 10% penalty, plus any taxes for a traditional account. A Roth IRA is different. It allows withdrawals of contributions at any time for any reason. And you can withdraw your gains like the other accounts once you're at least 59 and a half years old and your account is at least 5 years old. Second, there are some income restrictions. We already talked about how traditional and Roth IRA have some income restrictions, which now gives us a chance to talk about the super not so secret backdoor Roth IRA. This is a legal workaround where you contribute to a traditional IRA, but then convert it to a Roth IRA. But why? Well, it usually comes into play when your income is above the Roth IRA cap, where you can no longer contribute to a Roth IRA. It's a way to still get the benefit, even if you technically make more than the income cap. Obviously, just be careful. It can get tricky with taxes, so you might want a tax specialist for this. But this is certainly a kind of special financial ninja trick that you can work your way up to. We've already looked at a lot of the pluses and minuses, but let's now tackle question 3. What are the advantages and disadvantages of each account and account type? Well, 401k's advantages include higher contribution limits, employer-sponsored / created accounts, and employer matches. Some disadvantages of 401k's are limited investment options and early withdrawal penalties. For IRAs, advantages include your choice of investments. And disadvantages include there's no employer match available. You sort of have to do all the work yourself. For traditional accounts, advantages include lowering your taxable income now. And disadvantages are that gains are taxed at withdrawal, and there are required minimum distributions starting at age 73. Roth accounts advantages include that your gains grow tax-free, and your withdrawals are all tax-free since you've already paid taxes on your contributions. Some disadvantages of IRAs are that they have income limits and lower contribution limits. A Roth IRA can also withdraw contributions at any time. Okay, so our final question is question number 4. Which ones should you use, and in which order should you use them? Well, it obviously depends on a few things. Your income now, your expected income and tax rate later, and really your overall goals. But here's my specific situation and what I'm doing. I get an employer 401k match, and I'm still eligible for a full Roth IRA contribution based on my income. So this is the approach I would take based on that, and this probably applies to many people. First, contribute into a Roth 401k the minimum amount required to get the full employer match. That employer match is 100% free money. Don't turn it down. Next, if there's more money left to contribute, maximize a Roth IRA. Then, if there's still more money after that, go back to the Roth 401k and maximize that. Notice I'm not doing any traditional accounts other than where my employer 401k match goes, which is a weird little nuance of employer matches, is even if you're contributing to a Roth 401k, your matches go into a traditional 401k. I've switched my 401k over to just Roth contributions because for me, the benefit of tax-free gains from Roth accounts is just too good to turn down. Now, there could be some specific situations where a traditional account is actually more beneficial for you. I would, of course, recommend you talk to a tax specialist to be sure, but my thoughts are that if you're hovering above one income tax bracket and contributing to a traditional account would bring down your taxable income and move you into a lower tax bracket, then it might actually be worth it in that scenario. But again, talk to somebody who knows more. So that's it. We've done it. We've answered our 4 key questions. And now you know what's a 401k and an IRA, what's a traditional versus Roth account type, what are the advantages and disadvantages of each account and account type, and which ones should you use and in what order should you use them. To wrap things up, here are some retirement account pro tips. First, always get that employer match. It's free money. Remember that Roth accounts grow tax-free, and that's a massive advantage in the long term. Number 3, don't forget to make your IRA investment purchases after you make your contributions. Just because you put money into the account doesn't mean you're done. It will just sit there as non-invested cash and not grow if you do that. And 4th, you can contribute to both an IRA and a 401k in the same year if you qualify. And in a lot of situations, that can be a really powerful combo. Thanks for watching. I'm not a financial advisor, but if you found this helpful, hit the like button and subscribe for more easy to understand finance and life tips. Also, drop your questions below and let me know if you're team traditional or team Roth or both. Until next time, save smart, live well, and remember, you don't have to be an expert, just good enough. Welcome back to That's Good Enough, where you don't need to be an expert, just good enough to realize that your script is not advancing. Cool. Let's fix that.